Gold's bullish tendency since our last report appeared to have diminished, with the precious metal entering its second week in the reds. The downward motion with a strong fundamental background, and we tend to note that there is still volatility ahead for the precious metal in the current week. Today we are to discuss the fundamental challenges laid ahead for the precious metal, while we'll be concluding this report with a technical analysis of gold's daily chart. The release of the US employment data for December last Friday indicated that the US labor market still remains tight despite the current interest rate levels. In particular, the non-farm payroll figure came in much higher than expected at 216K in combination with the greater than expected average hourly earnings rate at 0.4%, tended to imply that the US labor market not only remains relatively tight, but is also faring better than expected. The surprising resiliency from US labor market may have stoked fears that inflationary pressures in the US economy may remain elevated for the future, and as such the expectations by market participants of 6 rate cuts by the Fed during the year may have been over-optimistic. As such, with the possibility of the Fed maintaining the current interest rates for a prolonged period of time, market expectations of 6 rate cuts by the Fed dropped temporarily to 5 rate cuts for the rest of the year, which may have provided support to the dollar and thus may have weighed on gold. In conclusion, the dollar gained upon the release of the US employment data, which in turn led to the precious metal declining given the reverse relationship. Further financial releases from the US imply that the risk of persistent inflationary pressures remain elevated. We may see the dollar gaining further with the precious being weighed down. The US CPI rates for December are due to be released this week. In particular, the core CPI is expected by economists to increase at a decreasing rate, with the projected rate expected to come in 3.8% versus the prior rate of 4.0% on a year-on-year basis. Should the core CPI rates come in as expected, it could validate the current market expectations of 5 rate cuts by the Fed this year, as it implies that inflationary pressures on the US economy may be easing. However, the headline CPI rate is expected to increase at an increasing rate from 3.1% to 3.2% on a year-on-year basis, contradicting the theory that inflationary pressures are easing and, as a matter of fact, tend to suggest that inflationary pressures may be increasing. Moreover, in the event that the headline CPI rate comes in as expected or higher, it could dampen the current market's expectations of 6 rate cuts, thus potentially aiding the dollar, which in turn could weigh on the precious metal and vice versa. In conclusion, the divergence between the core CPI and headline CPI rates could offset their potential effects on the greenback, yet given that the Fed's favorite tool for measuring inflationary pressures are widely known to be the core PCE rates and not the core CPI rates, we may see a greater market reaction from the release of the headline CPI rates. On a technical level, we note that gold appears to be moving in a downwards fashion, having formed a downwards trend line, which appears to have been guiding the precious since its inception on the 28th of December. We opt for a bearish outlook for the precious metal, and supporting our case is the Bollinger Band median, which appears to be tilted to the downside, implying a bearish market sentiment, as also do the 50 and 100 moving averages, in addition to the RSI indicator below our daily chart, currently registering a figure of 40, implying a bearish market sentiment. For our bearish bias to continue, we would like to see a clear break below the 2015 support level, with the next potential target for the bears being the 1975 support line. Whereas for a sideways bias to occur, we would like to see the precious metal remain confined between the 2015 support level and the 2050 resistance line. Lastly, for a bullish outlook, we would like to see a clear break above the 2050 resistance level, with the next possible target for the bulls being the 2088 resistance ceiling. As this report concludes, we would like to thank you for being part of our financial updates. From all of us here at Iron FX, we wish you a solid trading.